Right. So on Tuesday, we we talked about the valuation of a company, and on Tuesday we learned about the discounted cash flow valuation as a primary method to evaluate the value of a company, and the core principles in the DCF valuation is that first you need to find the free cash flow from the projected income statements by adding and taking minus of some items in the income statements. So we have three components. The first one is the OCF, which is the operating cash flow. Second one is the CapEx, which is capital expenditure, and the third one is the net working capital. The change in the net working capital. So we learned how to calculate these components that comprise free cash flow, and then we used the weighted average cost of capital that we learned in the previous chapter as the discounting factor. And then you can calculate the value of the company as the net present value of the all free cash flows over the years. But at the time, because we are limited in time and effort, so we cannot do this process forever. So at some point we need to stop and guess about the future, and that can be done by allowing terminal value. And the terminal value means that we are going to approximate the free cash flows in the far future by having a value at some point. And today our topic is another alternative method to evaluate the value of a company, which is known as the relative valuation. So what is relative valuation? The relative valuation is the method to find the company's value by comparing it to similar companies in the market. So this is called as a relative valuation in the sense that the value of a company is determined relative to other companies' value. So this is contradict to the previous method we learned, which is the DCF valuation. In the DCF valuation, we focus on the company itself, but we do not care about the others in the market. But on the other hand, in the relative valuation, we compare the target's value, our main focus of our analysis, to the comparable other companies in the market. So the basic idea in this relative valuation is that similar companies will have similar characteristics. So for example, we can have multiple companies in the same market. So we have firm 1, firm 2, firm 3, and go on. And then we can imagine that the value of each company, V, will be related to some other measure or the performance indicator of the firm, and and therefore we can find some kind of linear relationship between the value of the company and the indicator. So let me give you a more specific example describing this. So suppose that there are three different companies, A, B, and C. However, they are almost the same. So they are very, very similar. So they produce exactly the same products, and they, in a way, exactly the same. And then they sell those products in the market exactly at the same prices. And in that case, the value of the company will be dependent to the revenues, how much they sell. So the company A sells A's revenues are 400 million, B's revenues are 200 million, and C's revenues are 8 million. And in that case, if we compare A, B, and C, we can say that A is 2 times larger than B, and C is 2 times larger than A, right? Because their revenues are 4, 2, and 8 respectively. And if we know that the value of company A's value is $2,000 million, and in that case, we can compare other companies' value to company A, and then we can guess about their values also. So all else being equal, which means all other characteristics are the same, and in that case, the value of these companies will be higher when they have more revenues. So for company A, the value of company was 2,000 in when its revenue was 400, and it will similarly apply to the company B and company C. So because we can find that the ratio between the market value and the revenue is 5, we can easily obtain the other firm's values as well. So the company B's value will be estimated as 1,000 because if we assume that we have a similar relationship between the value of each company and its revenue, and we should have the same ratio, which is 5. So company B's value should be 200, which is revenue of B times 5, so it should be 1,000. And company C should have 4,000 as its value because its revenue was 800, and then we multiply 5 to obtain the value. So this is the basic idea in the relative valuation. So we imagine that there are several companies that could be comparable to each other, and then we find the relationship between their value and some indicators or their performance, and in this example it was revenue, and therefore we find this ratio, and then we use this ratio to guess other firms' value. So if we generalize this idea, then we can say that a firm's value can be estimated as the multiplication between two factors. So the first one is a kind of financial ratio, which is obtained from other comparable companies, and the I is the performance indicator. For example, it was sales or revenues in the previous example. So we multiply R and I. And here, one thing that you have to note is that there is a relationship between R and I, because I is actually the denominator in this financial ratio. Therefore, if you multiply this, then easily you can get the value, which is the numerator in the financial ratio. So we can do relative valuations following these procedures. First, you choose the adequate financial ratio that represent the value of the company and that is severely related to the value of a company. Second, you select benchmark companies. By the term benchmark, it means they could be used as a guideline. So they are the compared companies. And third, you calculate the benchmark financial ratio, which is R here, based on those benchmark companies' average financial ratio. And then you apply those financial ratios into your calculation. And several financial ratios are popular in relative valuations, including price to earnings and EBITDA. So let me talk about each of them because they are frequently used, especially when you try to evaluate a firm's value in the stock market. So let me start with the price to earnings. Before doing that, let me just briefly summarize. So the price to earnings and the EBITDA, both of them are partially related to cash flows because they have their numerators are about the incomes, earnings, or cash flows. So in that sense, they are based on the assumption that if you have more cash flows or incomes, then you will generally have a higher firm value. So let me start with the price to earnings. So to understand the price to earnings, you first need to know about the earnings per share or EPS. The EPS is simply calculated as the net income divided by the number of shares outstanding. So and then the price to earnings is calculated based on the EPS by using the EPS as the denominator and using the stock price as the numerator. And because you will get market capitalization if you multiply the stock price and the number of shares outstanding. So this is the market capitalization or the market value of a company, market value of equity. And because EPS is net income divided by N, number of shares, if you once again multiply N to the EPS, then you again obtain the net income back. Therefore, the price to earnings is calculated based on per share, or it can be calculated for the aggregate firm. So if you calculate the price to earnings per share, this can be done by pricing divided by the EPS, or you can get the same result if you divide market capitalization by net income. So here is a company named Applied Materials, and its earnings per share is expected to be $1.07 in the next year. And the average PE ratio of the companies in the same sector, so these companies will be the benchmark, and their average was found as 24.05, and currently the stock price of the Applied Materials is approximately $19, and in that case you can use the price to earnings ratio to check whether the current stock price is too high or too low. So first, we can calculate the Applied Materials fair stock price or a more predicted stock price by multiplying the benchmark ratio, the PE ratio from the other companies, 24, and the Applied Materials EPS, because PE ratio is calculated as the P divided by EPS, and therefore if you multiply PE ratio with EPS, then you can get the stock price. So the PE ratio was 24, and the Applied Materials EPS was $1.07. Therefore, if you multiply it, and it will be your prediction about the stock price of the company. and it is $25.73. So you can find that actually the current stock price, the stock price in reality is only $19. However, your estimation, your prediction is that actually your stock price is higher. Therefore, we can expect that the applied materials stock price will go up. So this is the present, the stock price in present, and this is your estimation. So this is about the future. So we can say that although the stock price is only $19, but it will go up to $25. Therefore, we have to buy applied materials shares if we have done this kind of analysis. So because we are believing in that our analysis are correct, that means eventually the stock price will become $25.73. So using this kind of relative valuation is very easy compared to the DCF valuation, and that's why the relative valuation is very popular among investors. And let me talk about the second frequently used financial ratio, which is EV/EBITDA. So the EV/EBITDA is the enterprise value EV divided by the EBITDA, which is the earnings before interest, taxes, depreciation, and amortization. So this is earnings EBITDA. So that's why we call it as EBITDA. So this is related to the EBIT, and then you add back the depreciation and amortization, if any, then you can get the EBITDA. And here the enterprise value is calculated as the sum of equity and the net debt, and the net debt is calculated as borrowings minus cash. And again, the EBITDA is EBIT plus depreciation plus amortization. So if we consider the EBITDA, so in the DCF calculation, the discounted cash flow valuation, we talk about the operating cash flow. And the operating cash flow is calculated by having EBIT minus tax plus depreciation. So as you can see, EBITDA and operating cash flows resemble each other very much. So therefore, we can say that the EBITDA is closely related to the calculation of free cash flows. On the other hand, the PE ratio, in the calculation of the PE ratio, we rely on the EPS, and the EPS is based on the net income, which is just an accounting measure. So net income is far from the true free cash flow. So that's why compared to the PE, EV/EBITDA is more accurate in terms that from the point of view that we want to find the free cash flows. So that's why nowadays EV/EBITDA is more popular, especially among more developed countries, investors, and the financial institutions such as US market and European markets. And in Korea, we have used PE ratios very well. However, now the trend is moving toward the usage of the EV/EBITDA. I'm just going to skip the example of using the EV/EBITDA because that's very similar to the PE. However, let me just wrap up about the relative valuation. So there is also side effect. So there is a disadvantages in using using these kind of relative valuations compared to the DCF valuations. First, relative valuations are sometimes not possible when there is no comparable benchmark company. It can happen because sometimes you want to analyze a company that has a monopolistic power in the market. So in that case, there is no competitor. So in that case, you cannot choose a comparable companies that you want to compare between your target company and them. Second, sometimes the financial ratios are negative, which means as a result of your calculation, you will get a negative stock price. But in reality, because negative stock price is not possible, it means your logic is not clear in this case. For example, sometimes you want to use the PE ratio to calculate or to estimate a firm's value, and then eventually you find that the company's net income is, for example, minus $100 million, and actually it has no net income, it has net loss, because this is very young, and this, however, it is growing. And then if you calculate the EPS of this company, then it should be negative, and therefore as a result of your calculation, the stock price will be some PE times negative number, so it will be lower than 0. Then this is not possible, and there is something wrong with this estimation. And a typical example is the Coupang, which is a Korean version of Amazon, which is an e-commerce company. And although it was able to get a positive net income this year, before that, it had been shown a negative net incomes for 3 and 4 consecutive years. However, contradictory to this finding, actually the Coupang's IPO was very successful, and Coupang was able to raise a lot of money from its IPO, which means the stock price was evaluated to be very high from the point of view of the investors. And that's because people have believed in the Coupang's potential to become larger in the future. So the PE ratio does not reflect the future, especially for those young companies. So that's why relative valuation can result in very serious falls in the calculation of the firm's value. Third, sometimes the current stock market situation is biased, which means there is a boom or there is a bust. So actually you are comparing it to other companies' stock market. However, the other's stock market is wrong, therefore you get a wrong conclusion. So again, it happened recently during the COVID-19 situation. So during the COVID-19 pandemic, a lot of governments around the world had supported the people's lives by giving some money to them directly, and actually it caused a lot of inflation and also a lot of market booms in the market. So actually we have observed very high stock market returns during this period, and during that period a lot of companies tried to have an IPO because they knew that because now the stock market has a bubble, so if they go IPO right now, and their value will be overestimated. So they enjoyed this kind of situation, and there were a lot of IPOs during this period, the pandemic. So this shows that this is an evidence that the relative valuation could go wrong if the current market situation is not fairly measured, or when it is biased. So what is our conclusion about valuing a company? So we have learned 2 different ways to find or estimate a value of a company, and then more advisable, a more recommended way is to use the first one, the primary method, which is the discounted cash flow valuation, because relative valuations have a lot of limitations. On the other hand, discounted cash flow valuations, if you can make some good assumptions, then the results are very rational, and therefore if you make your decision based on this rational valuation, then you can be successful in measuring the value of the company. However, because we want to make sure whether our DCF valuation is correct or not, and in that case we can use our relative valuations as a complementary measures for the DCF valuations. So, for example, one can do something like this. First, you do the DCF valuation to estimate a first value, and second, you can guess the maximum and the minimum boundaries of the first value based on the relative valuations. So, for example, you obtain, okay, so this is the lower bound and this is the upper bound, and then use these boundaries or the intervals as a check for your result in number one, the result from the DCF valuation. So if your DCF valuation gives a number which is between the lower bound and the upper bound from the relative valuation, then it means both methods are pointing the same point. Therefore, you can say that, okay, I didn't make a serious problem in the DCF valuations. So this is a way to complement the DCF valuations by using the relative valuation.